Gary DeWaal here, and this is Bridging the Week for January 12th to 16th, and today is January 19th, 2015. Good morning. Last week, the Securities and Exchange Commission followed the Financial Industry Regulatory Authority's lead earlier this month by publishing examination priorities for 2015. Also, an SEC registered investment advisor and its owner, featured in a best-selling book by Michael Lewis, were sanctioned by an administrative law judge before the SEC for misrepresentation and fraud in connection with their role in the purchase of subprime mortgage-backed assets for certain collateralized debt obligations that subsequently were sold to investors. Many of you are viewing this on Tuesday, January 20th, after a 3-day weekend in the United States, in honor of Martin Luther King Jr. So I know you're in a hurry to catch up. So let's get going. The Securities and Exchange Commission's Office of Compliance Inspections and Examinations published its priorities for examinations of investment advisors, broker-dealers, and transfer agents during 2015. In addition to matters relevant to business with retail investors, OC indicated it will focus on reviewing broker-dealers' cybersecurity compliance and controls, potential equity order routing conflicts, for example, are firms choosing trading venues based on payments or credits for order flow, clearing and introducing broker-dealers' anti-money laundering programs, especially for firms that have not filed suspicious activity reports or filed incomplete or late SARs, as well as broker-dealers that provide customers with direct access from high-risk jurisdictions, and never-before-examined investment companies, among other priorities. Earlier this month, the Financial Industry Regulatory Authority highlighted its focus during its 2015 review of broker-dealers. Between these two previews, the industry has a pretty good sense now what are the hot-button items for regulators this year. Clearly, cybersecurity and AML are both high on the list. Be mindful. Harding Advisory and Wing Chow, two of the subject of Michael Lewis's The Big Short Inside the Doomsday Machine, were held liable last week for misrepresentation, failure to follow an appropriate standard of care, and fraud for their role in the purchase of subprime mortgage-backed assets for certain collateralized debt obligations that subsequently were sold to investors in an administrative law judge's initial decision before the Securities and Exchange Commission. The Big Short, you will recall, is a recount of certain investors who profited by trading against the subprime mortgage bond market during the 2008-2009 financial crisis. The SEC's Division of Enforcement previously instituted these proceedings in October 2013. At all relevant times, Harding was an SEC-registered investment advisor, while Mr. Chow was the firm's owner and founder. The division charged that, during 2006, Harding Advisory, acting as a collateral manager for one CDO, Octans 1, structured and marketed by subsidiaries of Merrill Lynch & Co., granted a third-party hedge fund the right to review all collateral before purchase and effectively exercise veto rights. This was never disclosed to debt investors in Octans 1, claimed the SEC. Subsequently, Harding deferred to the hedge fund's collateral suggestions, which was helpful to the hedge fund, but not to the CDO's investors, claimed the SEC. The SEC also charged that, during 2007, without adequate credit analysis, Harding acquired tranches of another CDO to include in other CDOs that it managed, known as CDO, as a favor to Merrill and the same hedge fund, to the detriment of the other CDO's investors. The judge ruled that Harding violated only some, but not all, of the specific allegations made by the division, while Mr. Chow was primarily liable for, and solely caused Harding's NOMA, not Octans 1, related violations. Notwithstanding, the judge imposed penalties of over $1 million in disgorgement and prejudgment interest against both respondents, imposed a fine of $1.7 million against Harding, and a fine of $340,000 against Mr. Chow, revoked Harding's investment advisor registration, and barred Mr. Chow from association with the securities industry. A film version of The Big Short, by the way, starring Brad Pitt, Ryan Gosling, Christian Bale, and Steve Carell, is expected in the near future. Stay tuned for more. Two security exchanges registered with the Securities and Exchange Commission, Edge A Exchange and Edge X Exchange, agreed to pay $14 million to settle SEC charges related to their failure to describe order types used on their facilities in mandatory SEC filings. Subsequently, the exchanges described these order types fully to some members, but not others, claimed the SEC. The exchanges were previously owned by Direct Edge Holdings and are now owned and operated by BATS Global Markets. The SEC said its fine in this matter was the largest fine it has ever levied against a national securities exchange. The Securities and Exchange Commission filed a civil action in the U.S. federal court in New Jersey against Alexander Milrod, claiming that he engaged in a disruptive trading strategy known as spoofing or layering in connection with high-speed purchase and sales of various exchange-traded securities from January 2013 to the present. According to the SEC, Mr. Milrod, a Canadian citizen, used other traders, primarily in China and Korea, to place multiple, quote, non-bona fide orders, end of quote, for stocks to induce other traders to trade on one side of the market at, quote, artificially inflated or depressed prices, end of quote, and then cancel the orders. Mr. Milrod and the other traders engaged in this strategy to effectuate orders to purchase or sell the relevant security on the other side of the market, charged the SEC. Concurrently with the filing of the SEC action, Mr. Milrod was criminally charged with 1 count of conspiracy to commit securities fraud and 1 count of wire fraud before the U.S. District Court in New Jersey related to the same activity in an action brought by the U.S. Attorney's Office for the District of New Jersey. And finally, Summit Energy Services, Inc., a Louisville, Kentucky-based firm, was fined $140,000 US by the Commodity Futures Trading Commission for advising its clients regarding the advisability of entering into over-the-counter natural gas swaps and natural gas commodity futures for compensation without being registered from October 2012 to September 25, 2014. During the relevant period, Summit held itself out on its website as a quote-unquote risk manager, providing risk management services regarding the value or advisability of trading in natural gas swaps or futures, and had more than 15 clients. Most of Summit's clients apparently were commercial entities that purchased physical natural gas and electricity as part of their electricity needs, as part of their energy needs. Keep in mind, generally, persons who advise other persons for compensation or profit regarding the value or advisability of trading in futures or swaps must be registered with the CFTC as a commodity trading advisor. There is an exemption for persons advising 15 or less persons over the prior 12 months and who does not hold themselves out to the public as a CTA. Keep in mind that important "and." Summit agreed to pay the fine as well as consented to cease and desist from further violations. Well, that's it for this week's Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal. Have a great week and ciao!